Price is what you pay, value is what you get. Warren Buffett's famous words have never been more relevant than they are today in 2026. True wealth is built by finding quality businesses with wide moats trading at or below their fair value. And right now, some of the highest quality businesses in the world are trading at reasonable, even attractive valuations. Today, we're looking at 11 stocks that represent exactly what value investing is all about. Exceptional businesses with durable competitive advantages, trading at prices that give us legitimate margins of safety. For the most part, these aren't speculative plays. These are companies with wide economic moats, strong cash flows, and valuations that make sense. And to ensure this is a completely unbiased list, I've made sure that none of the stocks in this list are ones that I own. However, after this video, I might buy some. And to make it even more challenging, I haven't included any of the Magnificent Seven. So let's dive right in. Let's start with two businesses that essentially operate as toll booths on the global economy, and that would be Visa and Mastercard. These companies don't issue credit, they don't take on unnecessary risks, they simply facilitate transactions. Every time you swipe your Visa or your Mastercard, they collect a small fee. It's a simple yet beautiful business model. And both are capital light, high margin, and highly scalable. As well as that, both have really wide moats, and that benefit comes from their dominant network effects. For instance, Visa has over 5 billion cards in rotation across the globe, and Mastercard has nearly 3.4 billion the last time I checked. And the more merchants that accept these cards, the more valuable they become to both the consumers and the businesses. This creates a bit of a loop that's nearly impossible for competitors to break. There's also massive switching costs, so financial institutions have deeply integrated these networks into their systems. Merchants have trained customers to expect them, and you just don't swap out a Visa or Mastercard overnight. In terms of recent performance, Visa reported 15% revenue growth in Q1. That was driven by an 8% growth in payments volume and a 9% in processed transactions. Mastercard actually matched that. They also had a 15% net revenue growth in Q4 of 2025, and their value-added services segment grew 22%. Looking to the future, what's driving growth? For Visa, it's their Visa as a service stack. So that includes tokenization, tap to pay, and technologies like stablecoins and digital commerce. Visa is also positioning themselves as the infrastructure layer for the future of money. Mastercard is taking a similar approach with Mastercard Move, and that includes cross-border payments and a new AI-powered product like Mastercard Credit Intelligence. They're also expanding aggressively into emerging markets. And I really want to be fair with all these stocks, so I'll endeavor to highlight some of the key risks. For Visa and Mastercard, the risk here is pretty much regulatory risk. Both companies could face fee caps and antitrust scrutiny, especially in markets like Europe. There's also competitive pressure from alternative payment methods such as real-time account-to-account transfers or even central bank digital currencies. And their performance is tied to consumer spending. So if we have a recession and transaction volumes decline, so could revenue. So which one do you choose? Honestly, both are exceptional, and I'd be happy to have both in my portfolio. Visa is slightly larger and has a deeper penetration in the United States, whereas Mastercard is more diversified globally, and their value-added services are growing a little bit faster. In a perfect world, you would own both. If you only had to pick one, Visa offers slightly more stability, whereas Mastercard might offer marginally more growth. Either way, you're buying into one of the best businesses in the world. Next up, we have our Wall Street giants, Morgan Stanley and Goldman Sachs. Both are experiencing a resurgence in investment banking activity after a few lean years. The regulatory environment is improving, deal flows are accelerating, and both firms are well placed to capitalize in that sort of environment. Morgan Stanley, they have $8.9 trillion in total client assets and $7 trillion in wealth management alone. That's a 30% margin business with sticky recurring revenue. They've built this incredible integrated platform where wealth management feeds into investment banking, which then feeds into asset management. And then you have Goldman Sachs. This is the #1 merger and acquisition advisor globally, and they've already advised on over $1 trillion in mergers and acquisition volumes year to date. Morgan Stanley, they delivered $8.2 billion in revenues in Q3 of 2025, with 23.5% return on tangible equity. Their wealth management business hit a 30% margin for the first time, and they still have over 300 basis points of excess capital to deploy. Goldman posted $15.2 billion in net revenues with $12.25 in EPS and a 14.2% return on equity. Their asset and wealth management business reached a record $3.5 trillion in assets under supervision, and they raised $3.3 billion in alternatives in just one quarter. And I've discussed this in recent videos, but I think both firms are really well placed to respond to the rise in AI and actually deploy that within their firms to find areas where they can find efficiencies. So I think this will become a bit of a broader trend within the industry. And Goldman and Morgan Stanley are very well placed to respond to that. However, it goes without saying there are some obvious risks. These are very cyclical businesses. When markets turn, deal flows dry up, trading volumes decline, and assets under management shrink. We saw this play out in 2022 and early 2023. There's also operational risks. These are extremely complex global institutions with exposure to counterparty risk, credit risk, and regulatory risk. One major operational failure or regulatory fine can wipe out a quarter's worth of profits. The other risk here is that both firms are trading at premiums compared to competitors like JP Morgan and Bank of America. So not that I provide recommendations, but what I would say is that it may be worth putting these ones on your watch list for when they are trading at more respectable prices. Now moving on to the semiconductors, TSMC and Texas Instruments. TSMC, we'll start with them. They are the world's leading semiconductor foundry. I'd be surprised if you've not heard of them, but they do manufacture chips for Apple, Nvidia, AMD, and basically anyone who needs their technology. And for that reason, the moat is pretty simple, as no one else can do what they do at their scale and at that quality. And one of the most important products is their 2nm tech. Which is on track for volume production in the second half of 2025, and they're seeing exceptional demand for AI accelerators, with that revenue expected to double this year and then grow into the mid-40s through 2029. They're also doubling their chip on wafer on substrate advanced packaging capacity to meet that demand. And on top of this, TSMC is also allocating 70% of their capital budget to advanced process technologies. Now, moving on to Texas Instruments. So they are a little bit different as they focus on analog and embedded processing chips that go into industrial equipment, automotive systems, and data centers. So they're a little bit less sexy, let's be honest, but nonetheless absolutely critical components to everything that operates in the world. In 2025, industrial, automotive, and data center markets represented 75% of their revenue. So that's up from 43% in 2013. This is a bit of a deliberate strategic shift from Texas Instruments towards markets with long product life cycles and high switching costs. And that's part of that moat that they're building there. So once TI's chips are designed into these systems or industrial controllers, that sort of thing, they stay there for actual years or in some cases even decades, which creates this incredible customer stickiness and recurring revenue. Another thing is they're also benefiting from Joe Biden's CHIPS Act incentives. So they're expecting $675 million in cash receivables in 2025, with $1.6 billion in direct funding expected beyond that. So that helps subsidize their manufacturing expansion and that sort of thing. Moving on to risks, and TSMC's risk is massive because it's geopolitical risks, and that's because most of their operations are in Taiwan, and any escalation with China could be catastrophic for global supply chains. However, they are investing $165 billion into Arizona to address some of that geopolitical concerns. However, still a massive risk. For Texas Instruments, the risk is basically cyclicality. Semiconductor demand is notoriously volatile. Basically, every chip company is like that. But they're also making massive capital investments, which will put pressure on free cash flow into the future. But, I would say the cyclicality of the industry is the biggest risk there. But at the end of the day, these businesses serve different purposes. So TSMC, it gives you exposure to that real cutting edge AI and high performance computing. Whereas Texas Instruments, it's slightly more defensive. They're more in that analog space, data centers, automotive systems, that sort of thing. So cars. So if you want to bet big on the AI build out, then you might be sort of angling for TSMC. But if you want a sort of more steady cash flow and dividend growth and that sort of thing, then you might go Texas Instruments as the more conservative play. In my opinion, both have wide moats and trade at reasonable valuations given their growth outlooks though. So both still very good options. So now we're getting into what I think are the three most underappreciated moats in the entire market, the financial data oligopoly. And if you've been watching the market, you know that these guys have been taking a beating in the last couple of weeks and the last couple of months. So this is S&P Global, Moody's, and MSCI. And they control the essential infrastructure that global finance essentially runs on. So that's things like credit agencies, equity indices, risk analytics, and other important financial data. And in a lot of cases, these aren't just nice to have products, they're regulatory requirements or industry standards that you actually have to really rely on. So they're the foundations of trillions of dollars of investment decisions. However, these businesses have sold off in recent months due to fears that artificial intelligence could fundamentally disrupt these businesses. And in my opinion, this is definitely a risk, but completely overstated. Okay, and what do I mean when I say it's completely overstated? Well, they have extremely wide moats that make it extremely hard to switch away from these companies. So the first one is extremely high switching costs. It's not just easy to get off these services. It can be really difficult just to sign up to a new company and then train your staff on how to use it. So as an example, MSCI, they have a 94% retention rate. Think about what that means, right? So if you have an institutional investor who integrates MSCI into their system, they build these investment products around them and then they train their team on how to use them. It's really hard just to flick the switch on that and move over to something else. You have to do all that process again. You have to create all these new products. So it's just a bit of a hassle and it's just not happening. And then you have S&P Global. And I would say that their moat is a bit deeper and probably the deepest out of all of them. So when you think S&P Global, you probably know the S&P 500. It's the benchmark for US equity performance. There are trillions of dollars indexed to it, and you can't just create, a competing index and expect investors to switch. The network effects are just too strong, and the brand is just too powerful. And then you have Moody's, and theirs is more of a regulatory moat. Credit ratings for Moody's and S&P are actually required for many types of debt issuance. So that's a firm sort of legal barrier that exists to entry into that market. And you're not going to prompt your way out of that. You're not going to prompt updates to keep up with regulations. You're not going to prompt to, make no mistakes, So there are some firm legal protections that sort of exist for this industry. And there's extreme sort of history that exists with these companies and with these brands. So in my opinion, they're not going anywhere anytime soon. There may be threats to some elements of their businesses. I think, a little disruption might help them to be a little bit more innovative and update some of their practices. And that could be good for the industry. However, I don't see them fully disappearing anytime soon. Now, I've sort of already touched on the risk of artificial intelligence, and I would say that's probably the biggest risk from an investor standpoint that's sort of confronting the sector at the current moment. It's dragged the share prices of a lot of these companies down, 20, 25%. And it's, I think, a broader theme that investors are going to have to confront throughout the next year. And, you have to think about, as an investor, when Claude puts out a new thing, a new Claude work or a new Claude product, or ChatGPT puts out something, a financial product, a legal documents product, how will investors react, and can I, as an investor, withstand that? And that's the same sort of mentality I think you have to go through in bear markets and in recessions and that sort of thing. Can I mentally withstand the risks that are sort of presented to me as an investor? And I think this is particularly poignant with artificial intelligence. It's really disrupting a lot of previously thought to be wide-moated businesses. However, now we're seeing that it's really disrupting a lot of businesses that have these wide moats, legal services, accounting, all that. So I think you just have to be mentally prepared to be an investor in some of these companies and go in there eyes wide open as to what might happen. What do I think about these three? With S&P Global, I would say it's the most diversified business. They've obviously got their ratings business, they've got their indices business, they've got commodities data, and they're also expanding into private markets. So with S&P, you've got a really the whole ecosystem. So with Moody's, it's more focused on credit markets, but they're seeing strong demand from refunding needs and private credit growth as well. And they're really this pure play on debt issuance cycles. MSCI, they're the index and analytics specialists, and they're, like I was saying at the top of this, their retention rates are absurd. And I didn't really touch too much on the pure business and performance side of things, but their margins are really beautiful as well. And as well as that, if you are concerned more about this AI trade and that sort of thing, they are leveraging AI probably better than almost anyone in the financial data space. So if that is something you're worried about, then MSCI might be a good one to have a look at as well. And finally, I wanted to talk about two cybersecurity businesses. And those two businesses that I want to highlight are Palo Alto and Fortinet. Starting with Palo Alto, which has really strong demand behind its security operations, its cloud security, and also the convergence of networking and security, which is projected to grow rapidly into the future. It also has a significant strength in the high margin firewall space, which should allow it to generate substantial free cash flow into the future, which is, as a value investor, always really important. Additionally, Palo Alto is likely to benefit as clients consolidate vendors and opt for a platform-based cybersecurity approach. And they're also making some really important major acquisitions. So they've got the pending CyberArk acquisition, which will make identity security a core pillar within the business, and then Chronosphere, which also adds observability capabilities. So essentially, they're building a comprehensive cybersecurity ecosystem. And then finally, we've got Fortinet. So it closed out 2025 with a really strong quarter, and that saw sales growth of 15% to $1.91 billion. And Fortinet is really the industry leader when it comes to firewalls, so they have over 50% unit market share there. And they've primarily achieved that through their proprietary chips technology. However, the firm is trying to map out a bit of a future beyond just hardware firewalls. And I think as we look to Fortinet's future, I think they really stand to benefit as security and vendor consolidation continues to increase because of some of those, proprietary technologies that they've got. So they've got obviously really high switching costs within the industry. And then you've got this really potent network effect, which will allow it to gain and expand the number of clients and continue to build that wide economic moat around its business. However, I think both are excellent and they're both positioned slightly differently. Palo Alto is an aggressive growth story, whereas Fortinet is a more efficient and more profitable company. In my opinion, both deserve consideration. However, I would say that Fortinet is probably the more pure value investor play. They've got stronger cash generation, more predictable growth, that sort of thing. But there you have it. So that's 11 stocks across 5 different categories. We've got payment networks, investment banks, semiconductors, financial data, and cybersecurity. So what makes these value investments? It's really about exceptional businesses with wide moats and at prices that give us a margin of safety. And every single one of these companies has a durable competitive advantage, which isn't easily replicated. They're also generating real cash flows, not hypothetical profits, 5 years from now. And in most cases, they're trading at valuations that are reasonable given their growth trajectories and competitive positions. But I do want to hear from you. Which of these 11 stocks is the most interesting to you, and which is your value pick right now? It doesn't have to be one in this set of 11 stocks. It could be one that you're considering. Drop a comment below and let's discuss it. I'd also really appreciate if you found this analysis valuable. Please hit the like button, subscribe for more deep dives like this. But yeah, thanks for watching, guys, and I'll see you in the next one.